Hey there, Dave here. If you were to predict what the stock market was going to do based purely on looking at YouTube thumbnails, you would sell all of your stocks and never invest again. Oh, look, I'm guilty of it too. I mean, Graham, you're just as concerned about 2020 starting the next Great Depression as you are about this millennial spending $7,000 in a month. I mean, that's probably more than I spend. I think. If I were to do a what I spend video, do you think we could get Graham to react to it?
So shout out to Dave. He has no idea that I'm reacting to this video. Did you guys see his camera work?
Let him know in his comments.
There we go. Dave and I are on the same wavelength there.
Luckily, the stock market is not at all correlated to the facial expressions made by YouTubers, but the facial expressions are a direct correlation to click-through rates, so thank you for clicking. Today, I'm going to share real-world practical strategies that I've taken to be prepared in the event the stock market were to crash again like it did in March. So if that sounds interesting, hit the like button, leave a comment, help other people find the video. It really does help. If you're new here, my name is Dave Hanson. I make videos on YouTube about stocks, about credit cards, about personal finance, those kind of nerdy hobbies of mine. I try to keep my financial life as simple as possible, and I like to share my ways of thinking here on this channel, so if you'd like to be a part of that, I'll wait. Perfect, thanks. So I've talked about how my portfolio was down by $1 million back during the crash in March, which, by the way, this is a perfect opportunity for me to remind you that I'm not a financial advisor. I'm sharing my ideas to help you think about investing, show you some concepts, show you some tools, how things work. But as always, keep in mind that I'm just a guy on the internet. Do your own research, ask an actual financial advisor if you need advice. From my portfolio's low point on March 9th, where I was down over $1 million in just 19 days, I've been able to bounce back. In the middle of that crash, it was actually about halfway between the market's high point and low point, I posted a video about how I paused the stock market. It was all about how I was using stock options as somewhat of an insurance policy to help keep my portfolio from dropping too much more without having to actually sell my stocks. I think that video does a really good job of simplifying a pretty complex concept, how put options can be used to protect investments. So if you haven't seen it, watch the rest of this video and then you might want to watch that one next. And if you want to see more about what I'm invested in right now, check out my new channel, Dumb Money Live, where Chris, Jordan, and I do live shows twice a week all about our stock market ideas and trades. Anyway, I called the idea of using put options my stock market pause button. By comparison, what I'm going to talk about today might be considered an emergency brake. That's because it actually will sell your stocks automatically if the stock price crashes, all without having to watch it every minute of every day. It's kind of a way to set it and forget it. When the stock goes up, you make money, but if it starts to crash, you get out. I'm all about finding ways to make my money work for me without having to spend too much time actually thinking about it. The less time I spend thinking about it, the more time I have for my other hobbies like making YouTube videos. So for my market savvy viewers out there, you've probably already guessed that the emergency brake I'm talking about is using stop orders. Today, I'm specifically going to talk about my favorite variety, something called the trailing stop order. It's actually very easy to do, but it does come with some risks that I want to talk a little about, and I want to show you a real-world example of actually placing this kind of an order. First, let's talk about what a trailing stop order is. It's a type of stop order, so let's first explain what a stop order is. Sometimes those are called stop loss orders because it's basically an order to sell a stock if it were to drop down to a price that you specify. It's a way to stop your losses. So say you bought some stock for $100 a share and you wanted to cap your losses if the stock were to go down to, say, $90. You'd put a stop order in at 90. If the stock goes up, you make money. But if the stock were to drop down to 90, that stop order would be triggered and automatically sell your stock. The risk there is that it might quickly drop way below $90 before your shares can actually sell. So you'll end up selling for whatever price someone is willing to pay at the time. It becomes a live market order. So you can and usually do end up selling for a price that is lower than your stop price. So keep that in mind. And there is something called a stop limit order that lets you set a minimum price that you're willing to sell for after the stop price is triggered, but that's the topic for a future video. Today, we're talking about trailing stop orders, and they're my favorite kind of stop order because that stop price automatically adjusts up as the stock price goes up. But if the stock price starts going down, the stop price is locked in place. Let's take that same theoretical stock you bought for $100. Instead of a $90 stop order, you could place a trailing stop order for $10 below the current price. With a normal stop order, you specify the actual stop price. With a trailing stop order, you specify how much lower than the current price you want the sell order to be triggered. That's how far below the stock's highest point your sell price should be trailing. So if the stock goes up to $150, your trailing amount is still $10, meaning the sell order would be triggered if the stock price drops to $140. I usually use this kind of sell order for a stock that I'm pretty much ready to sell anyway, but that I want to be able to keep profiting from if there's current market momentum and the stock price is going up, and then sell it whenever it starts going back down. I like it because, especially when I'm not watching the stock market every day like I seem to have been lately, it basically watches my stocks for me. There have been lots of times that a trailing stop order has triggered on some stock that I wasn't paying attention to, and it ended up selling at the absolute perfect time. But there are times, especially when the market is volatile, like it has been lately, where a stock might have way more sellers than buyers, especially when the market first opens in the morning. That can cause the stock price to very briefly drop way lower than usual, as the market's trying to find anyone who's willing to buy. So that's the biggest risk, a sort of flash crash where you end up having your trailing stop order triggered, turning into a sell order right at the time there's not anyone buying. There are a few ways to deal with that. You could obviously cancel the trailing stop order at the end of every day, but that kind of defeats the whole point of my set it and forget it trading concept. Plus, you might actually want to sell in that kind of a flash crash because it might not have been a flash at all. It could have turned into an ongoing sell-off and you would have been one of the first people to sell. That could be a good thing. The way I manage that risk is being very thoughtful about the amount I specify for that trailing stop price. I said that you can specify a dollar amount, like the $10 trailing amount in our $100 stock example, but what I usually do is a little more flexible because instead of just specifying the amount in dollars, you can choose to specify it as a percentage of the current price. So the stock that you bought for $100 and want to protect yourself of losses if it goes down $10 a share could be entered as a trailing stop order of 10%. On day one, that would be $10, but as the stock price makes its way up to, say, $150, the trailing amount of 10% would make the price that actually triggers the sell order 10% of the new $150 stock price, so $15. That's nice because imagine a stock like Tesla that was $900 a month ago, but more than $1,500 today. It basically scales the price that triggers your sell order relative to the current price. Hopefully that makes sense. Let me try to show you exactly how to make a trailing stop order and how I try to pick a stop percentage that makes sense by looking at the range that the stock trades. I'm pretty sure every brokerage app has the ability to place a trailing stop order. I'm going to show you in the Robinhood app because their interface is easy to see on YouTube and they do a pretty good job of explaining all of the order types, even though it's a little hidden in the app. So Face ID. There we go. When you go to buy or sell a stock, it defaults to what's called a market order. That is, you'll be buying or selling at whatever the current market price is. Click buy. And on Robinhood and a bunch of other brokerage apps, in addition to being able to specify the number of shares, now with fractional shares, you can specify the dollar amount that you want to invest. So let's go to Apple, one of my favorite stocks. If you click on trade, this is where you would normally go to enter a market order. Click buy. If you click on the top right where it says shares, that lets you toggle between shares and dollars. And it also lets you use these other conditional order types, a limit order, trailing stop order, and stop limit order. Which one are we talking about? The trailing stop order. Now today we're not going to be buying. I want to show you how to use these conditional orders for selling stocks that you already own. So to show this in Robinhood, it looks like I have to actually have shares to be able to even see the sell button. So Robinhood, you win. I'm finally going to have to fund my account. I'll keep rolling. We'll see how easy this is. Deposit funds, continue, Bank of America. Don't look. Two-factor authentication, I like that. If you watch Dumb Money, you know that I'm also an investor in Robinhood pre-IPO, and I've never funded my account. So here we go. Continue. How much can I do? Let's do $5,000. Thinking. Success. Nice. Buying power 1,000. Oh. If you have more than $1,000 in pending deposits, the first 1,000 will be available instantly. So today we'll be playing with $1,000 of buying power. As of today, the most widely held stock in Robinhood accounts is Ford, so let's trade with that. So it's trading at $672. Let's buy, say, 150 shares. Not enough buying power. All right, let's do 140. Market order. This is the first time I've ever traded on Robinhood. Complete. Confetti and everything. For the first time ever, I own Ford stock. If you watch Dumb Money Live, you know that I'm getting a free Tesla by investing in Tesla stock, and Chris is getting a free Ford Bronco from his Ford options. But now I'm in Ford too. Yes, this is an amazing experience. Here are my 140 shares of Ford. Let's now try to sell them using a trailing stop order. And generally, I try to set a percentage value that isn't too close, so the stock has a little room to fluctuate up and down and hopefully continue an uptrend. But despite what you may have heard, stonks don't always go up.
Everything's just going up. Stocks only go up. This is the easiest game I've ever been a part of.
So I don't want to set a trailing stop percentage that's too big because I might be giving up too much of my gains or worse, selling for a loss. It really is all about your personal situation and your risk tolerance. For me, usually 5% is not enough. The stock usually ends up selling way too quickly, but 25% is usually too much. So 10 to 20% seems to be where I generally end up, depending on how ready I am to get out of the stock, or how much I'm comfortable having it go down, or how big the stock usually swings up and down in the short term. So if we look at the 3-month chart here on Ford and we toggle from this trend line over to the candle bars, I believe in the 3-month view, each of these bars represents one day. Yes, it does. So this shows you on a day-by-day basis the highest and lowest point for the stock, and the color indicates the range of the opening and closing price for the day. And if it's a red day, it means the stock opened higher and closed lower, and if it's a green bar, it means the stock opened lower and closed higher. Candle bars. I like to look and kind of see the tallest range for a day, so not completely scientific, but on this day, June 10th, the high was 734, the low was 677, so roughly a 50-cent swing for the day. Then I also kind of like to look at history and say, when would I have liked to have sold this stock? When it went to its high here on June 8th, the all-time high was 744, and it's kind of just trended lower and has been going up lately because they announced the Ford Bronco. But see, here on June 10th was a big drop, and then the 11th was an even lower day. It did recover a little bit, but I would not have been sad to sell if from this high point intraday on June 8th at $7.74, if I were to sell some at the absolute low on June 10th, which was $6.77. So that's roughly $1, and from the high point of $7.74, a dollar is a little more than 10%, so I'm going to set my trailing stop order at 15%. I'm going to press trade and then sell, and then where it says shares, I'm going to click that and go to these conditional orders, and I'm going to enter a trailing stop order. I should have looked at this sooner. It's a perfect explanation of how this all works. Continue. We're going to put our trailing percentage of 15%, and that means the initial stop price is $5.70. That sounds good to me. So continue. And then this is important. Time and force lets you choose whether or not this trade is going to be good for the day only, which basically means you're putting the order in, and then at the end of the day, if it doesn't get triggered, it gets canceled. Or you can leave it for up to 90 days in the future, which is what I like to do. Continue. We're going to sell all of our 140 shares. That means as of right now, if the stock were to go down and we sold it for 15% lower, it would be worth $797.30. We review our order. You're placing good till cancel. This is cool. I've never actually traded on Robinhood. Swipe, order received. Awesome. So there you go. My order is in. Robinhood's robot will keep an eye on it for me. If Ford stock goes up, I'll make money and my selling price will slide up along with it. But if it goes down by 15% from whatever high it reaches, the emergency brake kicks in and I'll sell automatically. Which is great because I'm not able to predict the future, and being able to admit that in itself should be worth a like.
Stocks only go up. This is the easiest game I've ever been a part of.
I hope that this was helpful, educational, entertaining, maybe at least 2 of those 3. And if you do want to see more stuff from me, consider subscribing. Even if you don't want to see more from me, definitely leave me a comment. Let me know that you've made it to the very end, because people who watch the whole video really are my favorites. You can check out that pause button video about options if you haven't seen it already, or watch whatever video YouTube thinks you might like here, and hopefully I will see you back right here for the next one. Until then, thank you so much for watching. I'm Dave Hanson, and I approved this message.